Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about sophisticated borrowers. Now, the Corporations Act, which is the body of legislation that regulates financial advice and the provision of financial products, including direct shares, bonds, and so forth, makes a distinction between wholesale and what they call retail clients. And it's assumed that wholesale clients have a sufficient level of financial literacy to, self-assess the appropriateness and the risks and of particular products, advice, investment strategies, and really enough know-how and experience to protect their own interests. And as such, when dealing with what's determined as a wholesale client, a financial services business has fewer obligations. Fewer obligations to make sure that it's appropriate for that person. Instead, that person, that individual that's high net worth or has a high income, can make their own determinations of whether it's right for them or not. It's my contention then that the same provision should be available to banks and mortgage brokers. So often the way that you would assess, say, someone with a net worth of $2,000 compared to someone with a net worth of $20,000, of course, will vary. So they're two different types of borrowers that should attract a completely different type of assessment. However, unfortunately, currently in the legislation, no such distinction exists or is allowed for banks. And what happens is you end up with some perverse outcomes, which I'm going to talk about, and I'm going to sort of take you through what I think needs to happen. So as I said, the Corporations Act makes a distinction between wholesale and retail clients, and essentially a wholesale client is anyone that meets the asset test or the income test. The asset test is a net worth of over $2.5 million, and the income test is pre-tax income of more than $250,000 a year. Now, there are some other tests that are available, including a professional investor test, so that's someone with their own AFSL license, a product value test, and a small business test. But mainly, it's the income and asset hurdles. Now, those hurdles were struck back in 1991, and I think we would all agree they're vastly outdated. Just because someone's has a $2.5 million net worth doesn't necessarily mean they're a sophisticated investor and they have the know-how and financial savvy to sort of make their own risk assessments. And if we adjust just for inflation since 1991 when those amounts were struck, the income test should be something closer to $490,000, and the asset test should be north of 4.9 or about $5 million, and I think that would make a bit more sense in today's dollars. Look, the idea though, distinguishing between wholesale and retail clients, is that that people that aren't financially savvy, that don't have enough knowledge and experience, need greater levels of protection, consumer protection, whereas give people that are very experienced investors, the room to consider various different opportunities, and to be classified as either sophisticated investor or wholesale client, depends on which part of the Corporations Act we're talking about. They're one and the same thing, but you need a certificate from a qualified accountant, and normally so an accountant would sign that off to demonstrate that you meet those hurdles. Now, importantly, I'll remind you, in September last year, the government announced that they would seek to wind back some of the responsible lending rules, and I did a podcast back then about those changes. The main proposed change was to sort of relax the obligations to verify how much a borrower is spending at a particular time and what they're spending on when applying for a loan. and that high expenditure levels essentially tell us nothing really about someone's ability to service a loan. And arguably, if you're spending a lot of money on a lot of discretionary items, that provides very strong evidence you have capacity to take on additional debt. Now, that bill that was drafted to enact those changes passed the House of Representatives in March this year and is currently before the Senate. It's been opposed by the Labor Party, the Greens, and some consumer groups. They don't want those responsible lending laws relaxed. However, the government's reaffirmed its push behind this legislation. Says there's nothing to see here, there's no consumer concerns, and the bill, as I understand it, is scheduled for a second reading next week on the 16th of June 2021. But if the bill doesn't succeed, there's, in my mind, an even greater need for sophisticated borrowers to be recognised and provided for in the legislation. And maybe it's one way or one avenue available to the government if the bill doesn't get across the line to try and deal with that. Now, what is the problem with treating every single borrower the same way? Well, there's a couple of examples that I want to share with you today that show how perverse the whole borrowing situation has become and how rigid it is, not allowing lenders, whether they want to or able to, under law, to distinguish between two separate borrowers in two separate circumstances. Okay, so the first one is I would term asset-rich, income-poor. So this is where clients have a very strong asset base, but not necessarily a traditional income stream like a PAYG job. Now, a perfect example is we've been helping a client borrow $650,000 to purchase a property for $1.25 million. So it's about a 50% loan-to-value ratio. They don't have any other debt at the moment, and the client has approximately $20 million of assets in cash, shares and superannuation. So very high net worth, obviously receiving all their income from dividends, interest and super pension payments, but very low, zero borrowings, and all we're looking to do is borrow $650,000. Now, the bank's approach to this is to say we're going to ignore all historical dividend and interest income and instead use a deeming rate of 0.25%, 0.25 of 1%. That means that when looking at an asset pool of $20 million, the bank's going to assume that these clients are only going to generate $50,000 of income off that asset base. And sure, there's going to be some rental income from the property, but when they compare that to living expenses, they turn around and go, oh, we can't lend these people $650,000, even though they've got $20 million of financial resources. And I think this credit policy of applying a deeming rate might be really sensible for, your mum and dad sort of borrowers where they've got traditional income and maybe they've got a few $1,000s in shares. And what this policy does is sort of suggest, well, we're going to ignore any income that comes from the shares and we'll just rely wholly and solely on your employment income. And for a traditional mum and dad borrower, that is probably a sensible policy. Whereas if you apply this same policy to a high net worth individual, particularly asset-rich, income-poor, you end up getting a really dumb answer. Now, we've got the loan approved, but the process to go through, the hurdles to go through to prove or demonstrate was insane. If you're not going to lend $650,000 to someone that's amassed more than $20 million of wealth, I would argue you're not going to lend to anyone. Okay, so that's the first example. The second example, which is pretty common, is where we have large amounts in offset. So it's very common for our clients, particularly the ones that are approaching retirement, to have a large amount of borrowings, but also that those borrowings are either fully or mostly offset. I was looking at a client before, about $2.5 million in debt and about $2 million in the offset accounts, and net debt of only $500,000. And that's prudent. We talk to our clients about reducing debt as they approach retirement. But when it comes to borrowing capacity, the banks ignore the money in the offset account on the basis that, hey, you could go out and blow that money tomorrow, and if you did, you'd have to pay interest. However, common sense tells us that anyone with $2 million sitting in the bank in an offset account is probably pretty good and pretty prudent at managing their own financial affairs. And it's very unlikely they're going to be spending that money frivolously tomorrow. And in fact, if they end up spending that money, it's likely they're going to be thinking about, well, if I take the money out of the offset, I've got to pay for interest. And their conservative approach has probably landed them in the current financial position in the first place, so we can assume that they're going to continue to make prudent financial decisions. So I'm not saying ignore all the rules in this situation, but take into account we've got someone that's a little bit different. We've got someone that has runs on the board to prove that they're a sophisticated borrower, that they're smart people that make astute financial decisions, and perhaps the fact that they've got $2 million in the offset account is actually the strongest evidence that they can afford to service more debt. So that's why I think it's time now that the legislation provide for two types of borrowers, retail borrowers and sophisticated borrowers. Now, the credit rules started to tighten back in 2009, just after the GFC, and most of the regulatory holes were plugged by the time the Banking Royal Commission occurred in 2017. So a lot of that work in terms of tightening the rules around borrowing, which were ridiculously loose pre-2009, most of that work has already been done. And it is absolutely sensible to make sure that brokers and banks have a responsibility to make sure that they're only giving loans to people that can afford them. But also, by the same token, it also makes absolute sense to treat different people differently. And obviously the Hawke government, who introduced the corporation's definition of wholesale and retail clients, recognised that different people with different levels of financial literacy and capacity have the ability to make their own decisions and don't need the levels of protection that other people need. And in fact, it makes for a far more efficient market if you don't make everyone jump through the same level of hoops. And it's my view that the credit laws must make the same distinction, that higher income earners or people with higher net worths are usually able or in a position where they're able to assess whether it's prudent for them to take out a new loan or not. And in fact, the approach that banks use to assess those individuals should be different to the ones where you've just got a normal mum and dad sort of borrowers that have got PAYG jobs. In some regards, it's more of an asset lend than an income lend. So when you're dealing with a high net worth individual, you're really lending against their financial resources rather than their ability to go out and earn an income. And that distinction needs to be made. It certainly is present to some degree, but really the legislation needs to provide for that. So perhaps the definition of a sophisticated borrower could be someone that fulfills one or all three of having, say, an income over $400,000, a net worth over $3.5 million, or total aggregate borrowings over $3 million. Now, look, the exact hurdles, of course, are open for debate. It's just merely an example, but really some distinction between a retail borrower and a sophisticated borrower. Of course, banks must be given a very robust framework to work within, but also then enough discretion to operate within that framework to achieve some acceptable outcomes. And distinguishing between a retail and sophisticated or wholesale borrower, I think, is the first logical step in that direction. Okay, so I'll jump off my soapbox here. Just an idea to really help borrowers out there and certainly banks and mortgage brokers dealing with those borrowers. If you like the idea, please share it. Please get it out there. I'll certainly be running it past the Australian newspaper. And hopefully if enough people think it has merit, it might be able to affect some change. All right, that's it for me for this week. Until next week, bye for now.